Alright guys, look, this is going to be a hard-hitting video. I'm going to be honest here. Not the biggest fan of the company, MPW, Medical Property Trust, but I'm going to tell you why, but I'm also a very large shareholder, at least by my standards. I have 10,000 shares of MPW. Here they are, proof. And I was about to get 10,000 more. If you scroll down, dividends coming up. If you scroll down, you'll see that I had sold, 100 puts on the company, gaining $900 for it. And I decided to back out of that trade at a profit of $500 shortly after. I still might enter further if the price action drops down towards $4, but we'll see what happens. So anyway, I want to first start with an overview of the price action of the company. You'll see that I'm going to be using allreits.com to do a basic real estate investment trust analysis. They have a lot of factors there, a lot of terms, a lot of numbers that are relevant for REITs specifically, so I recommend that site. I'm not affiliated with anyone, including that site, by the way. Obviously, I'm not affiliated. So it's called allreits, ALREITS.com. And I just happened to look up MPW. They have a really helpful graphic here in the top right corner that tells you basically the strengths and weaknesses of the company. You'll see that the payout ratio is fantastic, perfect score. Years since IPO is also green, full green, 100% score. The biggest problems here are the debt, normalized FFO growth, and normalized FFO per share growth. So, price action. This company has seen a steady rise ever since the 2008 debacle, the great financial crisis, where it dropped as far as in the ones. And since then, the price action has actually been pretty positive. During 2020, March 2020, of course, everything crashed. It went from into the 17s all the way down into the 11s. And then it had a swift recovery through the pandemic years. And finally, in 2021, something the company could not hold anymore. Too many straws that broke the camel's back. And the biggest problem really with the company is debt, which I'm going to be talking about in depth later on in the video. I have the 10Q up. I have, some other analysis of other REITs just to compare metrics. So we're going to get all into that. So first, market cap. This is the situation, right? The market cap of the company is just under $3 billion. Its normalized FFO is 2.9x. And they basically comprise the entire sector of what they do, so it's hard to compare it to something else. But just to give you a picture of what this number is compared to other REITs, normally REITs are trading somewhere between 12x to 15x. So this company is trading like 5 times less than a REIT should. Is that justified? Well, perhaps. Here are the returns, over 10 years. Obviously, they're negative. Look at this big drop all the way down into 478. I think it's actually 482 as of making this video. And it's back down to, prices that this company hasn't seen since 2012. The dividends, these are a little bit wrong. They did not issue a 15-cent dividend in 2022. This side is more accurate. It's called stockanalysis.com. Again, not affiliated. This is my favorite site to look things up. And you can go to the dividend history of the company here. You can see that they've issued, 2 15-cent dividends. Actually, I think this September one, I think this was actually 29. So maybe this website is wrong. But either way, this is the dividend history. You can see how they had been steadily increasing the dividends until June 14th, when the dividend fell all the way, to 15 cents. And they're probably going to keep it there for quite a while. Back to allreits.com. Dividend growth, obviously, not bad. Payout ratio is only 35.9, just to give you an idea. The 5-year average is 63.9, and the payout ratio for REITs, normally if it's under 80, if it's under 75, that's considered pretty good. So this one is a 35.9, which means that they can cover the dividend very, very, very easily. The reason they do that, though, is because they actually make a lot of mistakes and they have a lot of transactional expenses that they have to do, and a lot of bonuses to issue. So they need that extra buffer. Trust me. Like, I actually wanted them to cut the dividend like 90% instead of just 50%, but that's a whole nother topic. Comparing it to the 10-year bond, 10-year currently is sitting at 416 or thereabouts, whereas the yield for MPW is at 12.55, so more than triple the dividend of the 10-year. So is it worth the risk? Probably. We'll find out. This number really matters. Normalized FFO per share. So you want to look at the per share metrics. And it has dropped since 2022 to $1.67 per share. And it probably will continue to drop. I mean, they have been selling properties pretty aggressively to manage their debt situation, which I will get into. And with that comes less earnings. And this number will continue to drop. I doubt it will drop back down to the 2019 levels. But even in 2019, the company was priced way higher than this, at FFO per share, normalized FFO per share at 130. That's fund from operations. In 2019, the price of the stock was skyrocketing. I mean, it was like $13, $14, $15 per share, $16 per share. So right now it's $4.80 with the same, funds from operation. But the difference is that the debt, of course, has soared since then. The company had about $7 billion in debt and change, and now they have over $10 billion in debt. And so that is a big anchor and a big drowning force for the company. One thing that's good to see about this is the occupancy rate is at 99.5, but you have to make sure that you take that with a big grain of salt, because even though all of their buildings are occupied by hospitals, not all hospitals are actually paying rent, and we can talk about that. And not only some of their hospital operators aren't paying rent, their biggest ones are not paying rent, and this is not that diversified of a company. You can see that the largest tenants comprise a fairly large percentage of their total portfolio, although to their credit, and as of late, they have reduced that reliance to single tenants. And Stewart used to comprise 38% of total tenants. Now they comprise 20% of total tenants. So that's good. I think they have less than 441 properties now. But either way, they have a ton of properties that are leased to many different businesses. I think they've exited from Australia now completely, but they do have many European properties, including, I think, very heavily in UK. I think maybe 21% of the properties are in the UK. So that's all REITs. Let's look at stockanalysis.com, see what we can find here. The main thing that I want to point out about this company is, and the reason why I'm in here, the reason why I'm invested in this company short term or medium term, is the fact that, I hope it goes to balance sheet here. I don't know what's going on. Oh, there we go. Is the shareholder? Oh no, you didn't. Is the shareholder equity? So shareholder equity has been dropping, obviously, as the value of their assets is decreasing in this rate rising environment. And the rate rising is one of the biggest things that's cutting into their income, basically. It has been decreasing, but it's still over $8 billion. However, the market is assigning a value of the shareholder equity of about under $3 billion. So It's a little bit of a problem, right? Like, let's look at the statistics and just see how big of a discount the market is applying to this company. Look at this. Price to book ratio is at 0.33. 0.33. No, it's just less than 1. It's 0.33. Let's take at other REITs that are healthy and take a look at what the ratio is there, what the price to book is. Well, the healthiest REIT that I own and that I know of is Realty Income with a price to book of 1.25. Other people may argue that's not the healthiest REIT, but whatever. Okay, give me an example and then look at their price to book. 1.25. Okay, that's fair. But that's a healthy REIT. What about a medical related REIT? Well, here's a couple examples. This one is Community Healthcare Trust Incorporated, CHCT. And the price to book for this one is 1.46. It's higher. It's higher than Realty Income. How about another one? Maybe this is a one-off. How about CTRE? Care Trust REIT. Price to book, 2.4. 2.4. Do you see what I'm dealing with here? 0.33 is an enormous discount. All right? Enormous discount. So I'm only invested really because I just think that the company is discounted like way too much. Are there problems? Yes, of course. And let's talk a little bit about these problems, all right? Let's talk about the situation and why the company is taking such a huge hit. I mean, let's take a look at that chart again from a different perspective. Like, look at this. Oops, that's not the right chart. Medical Properties Trust. Look at this. Look at this action right here. I mean, it's basically down to the great financial crisis lows. It went from a $24 plus price level, all the way down to 4.8. So what has happened? Well, when you lease your building to someone, and they're in trouble and they can't pay their bills, then your revenue suffers as well, right? You're not just immune if you just own a building. Yes, in many cases, if you're a landlord, you can kind of maybe kick your old tenant if the laws allow it, and unless they decide to squat on your property or something, and then you have to get the police involved, and they don't want to do it because they're going to end up on video and they're going to be scrutinized and get public backlash. And anyway, so it's very complicated to switch tenants, right? Especially if they're not willing. Well, with the medical situation, it's even more difficult because the hospitals, it's not like you can just find a new hospital that can replace them. It's very difficult to set up shop in the building that you own from a different hospital. The hospital, the building might sit empty for a very, very long time, or you could try to repurpose it. But that's difficult. Like, who wants to live in a hospital? Or good luck trying to repurpose it into office space. Like, that's never going to happen. I mean, office is just 50% occupied, like across the country, basically, or at least close to that. I'm not even joking. I'm not even exaggerating. Like, office buildings are sitting empty. You know, I think maybe not 50, but 40% of office space is like empty. At least when I look at most of the REITs that hold office space, that's the occupancy rate. It's embarrassing. So there's nobody who wants office space. Can't repurpose the hospitals to office space. I mean, you're basically just sitting on that building until another medical operator comes in along and runs it better. But how long is that going to be? It's not like there's a trillion hospital operators out there. So what they end up happening is, because your tenant can't pay their bills or refusing to or whatever, or it's just so much debt they can't literally get financing, you're the one who has to provide financing, right? You're the landlord. So basically you say to your tenant, hey man, don't worry, just I'll cover this month and try to get me back next month, which is a difficult proposition because once you get down this road, your tenant gets more and more burdened with debt that they have to repay. So unless they have some assets that they can sell, which is the case with some of the operators, then you're in trouble. And so now your operators, your tenants, get more and more straddled with debt, and they get less and less likely to be able to pay next month. And so it's a downward spiral, compounded by the fact that interest rates are rising. So what does the interest rate rising have to do with MPW? Well, a lot. If you have a ton of debt and you have $1.5 billion in revolving debt, and when those rates rise, you're paying through the nose. Okay, you're paying through the nose for interest, and the rise in interest they have to pay, I think it's like over $50 million now per quarter or something like that, extra that they have to pay in debt. Correct me in the math if I'm wrong. I just looked at the 10Q, but and when you have to pay additional interest, I mean that cuts directly into your profits, right, into your earnings, which means that you have less left over to do whatever you need to do, like distribute a dividend, pay salaries to your employees, whatever you got to do, give $12 million worth of stocks to your CEO or whatever has to happen, which is what's actually happening out there. By the way, that's a little bit of a controversial topic. I mean, I'm glad that the CEO is a big shareholder, but he didn't buy any of them. Like, they're all awarded to the guy. So anyways, plus he's taking like, I don't know, $1.5 million salary or something like that. So he's doing well. But that's a little side topic. The main thing that I wanted to bring up is that medical property trust has been hit by two areas of problems, right? First, the hospitals are not profitable. They're not making money. Now things are supposed to be, maybe turning around, at least on the earnings calls. Medical property trust claims that Stewart is doing better, is making changes, etc. But no one really knows. Like, we don't have an insight into the books of those operators, of those tenants. So we don't really know. We have to go by the word of the management of medical property trust, and it's in their interest to make things look rosy, of course. Otherwise, if they make things look dire, everybody's going to sell out of their stock, and they're going to be even less likely to get financing. And now, I mean, it's going to be just a complete mess. And their valuation is going to drop to like zero. They have to declare bankruptcy unless they make things look rosy. So we don't actually know what the truth is. The market is betting that the operators are in much worse shape than people are claiming to be. So we don't know. I mean, but one thing's for sure though, okay? The shareholders' equity is very high. There's a lot of equity into this company, and if they just sell all the buildings and pay off their debts, there's going to be money to be made. And this is the reason why I'm in it. They have gone down that road. We're still on the situation. They've gone on that road, and they've started to sell properties. They've sold the ones in Australia. Actually, you can see the debt over here is settled. Let me see if I can go to the 10Q now and see if we can get some insight. This is what I want to talk about first, actually. But this is related. So you can see right here. I'm sorry, this is a different topic. This is where they had to take I think this is the company that owns Prospect. So they had to become a large operator owner of Prospect. Whereas last year they had 0 shares of the company, but now they have 684 million worth. Yeah, this is in thousands. Okay. So this is their stake here. You can't see the 2022, but basically it was 0 in 2022, and now their biggest position when it comes to stocks is basically PHP. This is private stocks, basically. At least that's how much they paid out. We don't know what the actual value of this is. And of course, they made a loan to Stewart. It's here. It's reflected. They still have that outstanding, apparently, from last year. International joint ventures. So they have stakes in all these operators on top of the fact that they own a lot of buildings. All their business ownerships total to about $1.843 billion. So $1,843,000,000. But what I really want to talk about, okay, and I think I want to wrap up the situation here. Um, with what's going on, like moving forward, the plan is to sell more and more properties in order to fund their debt and try to improve the debt situation. When everybody who is selling the stock is keenly aware that this is a troublesome situation, right? If you have over $10 billion of debt, the interest, if it's increasing, is going to really, really hit your books. And it's not like they're making that many millions per quarter. All right, the interest is going to have a significant impact on how much cash is turning over. So let's take a look at the debt finally, okay, and the debt schedule. All right. So what are we looking at here? There it is. Okay. So revolving credit facility, it was at 2022. You can't see it, but it was 929 million. Now it's 1.354 billion dollars. So over 400 million more. And when interest rates go up, this is the thing that really, really needs to get paid off. On the bright side of things, though, there is a bright side of things. Here's the Australian sale property. Where was it? Australian term loan facility. So it went from 800 million to 300 million. So 500 million of those have been paid off. So that's good. On the bright side, there's a lot of debt that is locked in very, very low rates. Like the bears don't appreciate this as much as I do. Like outside of these top 4 or top 5 lines, okay, which it totals to about, I don't know, $2.5 billion maybe, just at a glance. Most of that other debt, so from here all the way down, is locked into very low rates considering market rates today. I mean, yes, there are some that are locked in at 5.25 and then some at 5, a couple of $1 billion, but those are not really due 2026, hopefully in 2027 for the 1.4 billion. So hopefully rates are low by then so they can kind of like roll that and refinance it. But even if they're not, like property values and everything are probably going to increase enough to maybe they could sell it to a country or to another like wannabe landlord or to another REIT. There's still time to make a lot of maneuvers to save, the situation. Like you don't have to be crumbling and declaring bankruptcy over this debt situation. Like this debt schedule is not that bad. Okay. Like this first section, it really is the bad part. So it's like, $2.5 billion that have to be taken care of somehow. What I heard that on the call is that they announced, or in an article or on the call, I can't remember, but they announced a program where they're going to be selling $2 billion worth of property in the next couple of years to try to shore this up. And I think that's actually the right move, because outside of these problem areas with the high interest rate, I can't see why they have anything to worry about for the future with these like ultra low rates locked in. I mean, look at this. Look at this 2026, $500 million at 1%. What? Who gets these percentages? Another $500 million at 2.55. Like that's really good. And look at this long-term debt here until 2030 at 3.375. Like that's really good. $1.3 billion due 2031 at 3.5. This is pretty favorable. It's not really a problem. So as long as they sell enough properties to settle this initial debt here, I think they're going to be totally fine. And the market will recognize that. Yes, it's not going to be as big of a company anymore. These companies use debt to grow, and yes, it's not going to be growing, it's going to be shrinking, but the bleeding will stop. The bleeding will stop, and that's what's important. You want to stop the bleeding, okay? Once the bleeding stops and you're on stable ground again, then you can slowly start to begin to grow as the market conditions improve. It could take a few years, but this company can survive even in a high rate environment with this kind of debt schedule. And I'm sure over the course of the next like 5 to 10 years, they're going to be able to get their hands on some refinancing on some of their higher percentage debt. Like, who knows? I don't think that rates are going to be staying at 5 and above for the next 5 to 10 years. I can't see that happening. I mean, it's just already so much havoc wrecking around in the business world because of these high rates. Plus, they fluctuate. And if the rates happen to drop even for 1 year out of those 10.5, this company could and will. Obviously, they know what rates are going for like every single day. It's their job, basically. They manage so much debt. And they will refinance. Like, they're not going to miss the opportunity. These guys have been in business for a while, and they got a lot of white hair on their head. So I know that they know what they should be doing. So I can't see this company evaporating. Like, it would be very difficult. I think in the short run, if they fail to sell buildings, I agree. So far, they've managed to sell some buildings and settle some debt. But yes, all right. There is risk. Like, if they fail to sell their properties for a reasonable price, and they take a big L on it, and obviously there are transaction costs involved in the whole thing, then yeah, the company is going to keep melting away, and it could go lower, and there is a foreseeable scenario where rates stayed really high and they fail to sell their buildings and nobody wants to buy them, etc. But anything could happen, like a tornado could hit, and then a big earthquake can destroy like 10 buildings or whatever. But you just factor that in. Like, you have to take some risks as an investor. So that's my take on the whole situation. I think I just described the way out. I think they have the right approach. I think that by selling a bunch of properties aggressively and getting rid of the high interest debt is the way to go. And they can just kind of start clean and have their house in order. They pick up all the pieces from then on and just start growing as they can, without having to worry about this like overbearing interest expense. And in my opinion, they should have even cut the dividend 90%, like I said earlier in the video, just to shore up the situation. Because I hate to see like equity bleed away. Like, I would rather them not pay as big of a dividend, but be able to manage things much easier, much more aggressively, rather than it taking so long. And I think the price of the stock would have reflected that. But they still kept the dividend at 15 cents. They'd still be able to keep the REIT status if they drop the dividend more. Like, I'm not really worried about that. But it is something to consider, that this is a REIT and they're always going to try to maximize the dividend, because they have to get over that 90% hurdle somehow. But when you're this indebted, like, you have many levers to pull in order to try to accomplish that without having to decategorize your company as a real estate investment trust. But I think they have the right approach. We just have to see what the buildings go for, and I'm going to be looking for announcements of buildings sold. And also, the other thing that needs to be improved, obviously, is the operators. Like, Prospect and Stewart need to continue cleaning house. They need to continue improving their fiscal situation. We're still waiting for some sales for Prospect to be approved. We're still waiting for Stewart to make changes to their operating maneuvers in order to improve staff and the way they basically run their business. I will exit this company though, and I'll tell you why. I cannot be a long-term investor and let it go. And it's just because I saw a really big red flag in the company. I'll tell you right now. I mean, I was reading an article where, I forget which company. It could have been Prospect, could have been something else. But what the guys did, right? That they ran the company, which they later sold the buildings to MPT or MPW. They had a company, and they put out a loan, right? They have a perfectly good company. They pull out a $500 million loan. And what do they do with this loan against their company? They pay themselves $500 million of dividends. Okay, so they pocket the money. And then what do? They sell the buildings. Okay, they sell the buildings of their business to MPW and then settle the loan back. You see what happened there? So what effect does that have? Well, they pull out all the money from the business basically, and now they straddle their businesses which owned the buildings. They straddle them with the burden of having to pay lease on the building. So the business is now, it could have been perfectly fine up until that moment, but now it's no longer fine, right? Let's say, for example, that you're doing fine right now. Let's say you're paying $1,000 rent, or maybe you own your apartment or a house, and you're doing fine. You have you make, let's say, $2,000 a month, and you buy groceries, and you have your car payment or something, or I don't know. You pay for gas, and let's say your total expenses are $1,500. Well, now imagine that somebody sells your house and takes the money, all right? And now you have to pay rent on the house that you used to own, okay? And that rent is, let's say, $5,000. So now you're negative $3,000 each month, right? That's not a very good situation. That's not a sustainable situation. And if you keep taking loans, right, you're just making the things compound. You're just making things worse and worse and worse. Maybe you sell stock in yourself to others, which is what the situation is in some cases. You sell stock of yourself. Let's say you are a company, right? You work at McDonald's and you make $2,000 a month or something, and you sell stock of your earnings to other people for cash just to cover that payment. And now you don't even own your earnings. You have to distribute your earnings to other people. So now your income becomes less, and you keep borrowing and borrowing, and you become less and less able to pay what you owe. And eventually that thing is going to come crashing, right? Your debt's going to be so burdensome. It's going to be just like a tsunami waiting to collapse down on your head. And so I don't know how big this tsunami is on some of these businesses, but I saw that with at least one situation. And the fact that MPW was willing to make that deal happen. Look, perhaps I don't know all the details. That's fine. I could be mistaken the entire situation. If somebody knows, please educate me. But if a company does that, I don't like it. So yes, I'm investing in a company that I don't like, just because I trust the numbers. I trust what the numbers that they're represented appropriately, and I trust that they're gonna do what they say they're gonna do and get their debt situation in order. So I trust all of that, and once that happens, the market will reflect the accurate price of the company, and when that happens, I'm out. Okay, so that's the situation. That's the way out. All right, that's me. Okay, what that price is, I don't know. Probably $7. But I'm gonna end the video right here. Let me know what you think about the situation and what you are doing or what you would do if you were in charge of this company. All right, peace.